Thank you, gentlemen, for joining us. Well, we've had a few comments already on prices this morning. Volatility is the question of this panel, and we'd like to get your insights, obviously, on where you think that is going. Kieran, let me start with you. How do we check this volatility in the markets? Can it be done? Can OPEC do anything about it by what they do today? That has been their intention, as they, from what they've said.
Well, morning. I guess volatility, most of the people here this morning are traders as well. There's welcome and unwelcome volatility, and we normally find something to complain about. I think at the moment there's obviously what's seen as too much volatility, and that's impacting liquidity in the markets, and that's obviously a negative thing at the moment. I'm not sure it's particularly an OPEC thing to solve. High volatility jives with high flat price, and of course if OPEC takes some steps today to bring some stability to the markets, that will lead to a lot more market participation and less volatility. But going into winter, there's so many factors. There's geopolitical, gas and power in Europe, etc. like that. It's not just an OPEC issue.
It's not just OPEC, but yet they've said that as that their actions are trying to control that. Well, then what is it then? If it's not OPEC and if it's not fundamentals, it is, of course, a bit of everything. How much of it is to do with money flows, with actual liquidity in the market, given what we're seeing on the macro side with central bank policy, etc., quantitative tightening? Is that impacting? You
could say it's lack of money flows, because with this, the volatility is certainly a feature of the volatility has been the lack of liquidity in the markets and lack of market participation. Obviously, some of the margin calls back in Q2 of this year, driven by high flat prices, etc., led to very much some particularly physical market players just standing off and being a lot more selective in the business that they choose, and we just weren't seeing those traditional volumes coming into the market that we did 6 months before that, 3 months before that, etc.
Magid, hi, good morning again. Let's go to you. Maybe take one of the questions that we had before on oil prices and trajectory of those. What is influencing where the oil price is going to go in the fourth quarter and into next year? And where would you see it ending up also at the end of the year?
I mean, first I'd just like to add, I'll get to the point. There's only one way to solve for volatility.
Can you raise your... Yeah.
Sorry, there's only one way to solve for volatility, and that's to have increased certainty. That's fundamentally the problem, right?
Right.
Nobody feels certain about where things are going because you have both a supply problem and a demand problem. And then obviously that affects how people, trade flat price. And I think when we talk about things like, you have the uncertainty, which results in the volatility, and we've seen that, sort of almost double today versus historic levels, which results in higher margins, increased VAR. So all of the lack of working capital that's in the system at the moment is because everything's it's being trapped because all our models, our credit models, our VAR models, are driven by vol. Now, to determine what's going to happen in the future, on one side you have the equation of, will these problems drive a recession? And obviously that has one set of impacts. And if you don't have a recession, is there enough supply out there? Because I think a lot of the problems we have in our market are not true supply and demand. They're actually man-made driven issues. First, how did we deal with COVID? We could have dealt with it in different ways, but that had an impact. The Russian-Ukraine problem, again, another human element that's been brought into it. How do governments react to this? Some governments have basically put in caps into the markets, which is, again, causes problems because free markets are supposed to do certain things. Other governments have issued more paper, more money. So there's just too much intervention coming from too many different places, which is making it very difficult for anyone to predict what to do. And as a result, all it does is drive up the price which takes away the liquidity, because ultimately every trader in the room here, you know, has a certain VAR. They have a certain amount they can play with. And today, the tools that you have with the prices we have, they're reduced by half. And as a result,
they're taking a step back for now and wait and see. If we could just have the first survey question up just to have a look at it, because I'd like to put that to Thomas as well, which is, what's most at stake, Thomas? The longer oil markets remain in this sort of uncertain limbo, if you like. We've just heard that people are sort of taking a step back, a wait-and-see approach, what's going to happen to demand and supply. But what, as we continue on this path, you know, what is most at stake there? Very thin liquidity to ever-increasing liquidity? Are we going to see price discovery being impacted, hedging, margin calls, etc.? CapEx investment is a big one, and I'd like to go to you on that as well. So which of those would you say is going to be impacted the most? And I'd like to talk to you about the CapEx investment in terms of how energy companies can plan going forward, given all this.
Well, good morning, everyone. Well, as Magid said, it's accumulation of all these factors, basically. We've got major uncertainties on the supply and on the demand. And it's not gonna be over anytime soon. So I think we discussed the balances for next year. What are the balances for next year? Nobody has any clue. And it's so much depending on the recession, on what's going to happen in China. So that's for the demand side. And on the supply side, what's going to happen with the Russian flow? How much are we going to lose past December 5th? 0, 1 million a day, 2 million a day. That's a massive change. You know, in our industry where the prices is being determined by the margin barrel, 1 million barrel a day uncertainty is absolutely massive, and that happens in a time where the stocks are very low on everything, on the crude and on the products, and where the spare capacity, be it on the production and on the refining, is very low as well. So that's back to your question about capex. At the same time, we've got a lot of uncertainty on the cost of trading, as Magid mentioned as well. The high margin calls, initial margin and margin calls, are such that it's
yeah.
Should I start again?
No, please, Kieran. We can hear you, but everyone can raise their voice as well. It would help. Yeah.
So this is driving the volatility even higher than we have seen. Now, back to your question about capex. I think it's important to make the difference between the short-term volatility, which is the volatility at the front end of the market, and the volatility at the back end of the market. We've seen obviously the front end moving like $30, whereas the back end, if you look at December 25, it moved by a mere $15, which is a lot less than what we are seeing on the front end. And when you do this long-term investment, the capex investment, you look more at the long term than in the short term. Now, clearly, the world has been investing not enough on the oil and gas recently because of energy transition, because lack of visibility.
That's not going to improve given what we're seeing today, is it?
Sorry?
That's not going to improve anytime soon, given that people are being reticent and careful.
Yes and no. Yes and no. I think people realize that security of supply is something very, very important, that you need oil and gas for security of supply. Renewables is nice, but there's intermittency. So you need oil and gas in the near future. So I don't think that people are going to stop investing in oil and gas. Definitely not. We're going to have to, all the oil and gas companies are making a lot more money now, so more cash to be invested. And obviously they're going to invest a lot of it in the energy transition, but a lot as well in the oil and gas production. So I'm not as pessimistic as you are on the capex part.
As long as they keep making money.
See, I think this capex discussion it's a bit historically, if you go back 6 to 10 months, anybody who wanted to invest in the oil sector was getting punished in the capital markets. You saw in the stock markets, BP's share price was not reflecting its true value, and that's because they had not made the energy transition. And then after the war, people started getting rewarded for being long oil and long gas. So the capital markets don't work in a 3 to 6 month cycle. When people are making capex investments, those are 5 to 10 year investments in our sector. And for the last few years, we've been told as a community that oil is bad, renewables are good, the banks have basically told the investors they will not put money into certain sectors. So the real champions of developing this kind of products have been governments and national oil companies. But the capital markets have gone completely the opposite direction. So for CapEx to come back, the markets have to be told that it's okay to go back to the old economy for a period of time. Because at the moment, private equity and the banking sector is not open for business still for these long-term investments. The other problem is when you talk to analysts, the 10-year forward curve, people have deviations in price of about $20 a barrel. People don't know if it's going to be 80 or 120. The spread where analysts are predicting the forward oil prices are just so severe that it's not conducive to anybody who wants to make an investment to make that bet. So ultimately, it's going to fall down to governments and national oil companies to make those investments. The average capital markets investor is going to find an easier way and lower risk return for their money.
Okay, all right. Kieran, back to you. Let's look at this survey question as well, our second question, which is if this period of volatility sustains, I seem to have lost my mic, but hopefully everyone can see the question, how will it impact east of Suez and west of Suez markets differently? We've seen, obviously, the discounted Russian oil impacting certain flows already, but this volatility, how are east of Suez, west of Suez markets going to be impacted differently, if at all?
Yes, I think it will impact it differently for certain. I think if you just look at the base price of gas, and if we take west of Suez first, the price of gas into a refinery LP model is very much valued and runs determined by that. If we take the Middle East per se, associated gas coming up from the ground beside the refinery, it's not such a big factor in how the refinery runs or what those yields are. So I think that's probably a stark difference between the two, particularly with regards to European refineries right this moment. I think then if you look at the physical markets per se, as that volatility increases, again, flat price increases, etc., there's a little bit more, the volatility in the product price, etc., comes into play. And again, it tends to be developing countries that suffer from that a little bit. Therefore, they look further afield for cheaper product. You touched upon earlier the Russian flows, etc., like that, and therefore there's unnatural arbitrage that comes into it. So, yeah, I think there's quite a stark difference between East and West, with regards particularly to the gas price.
Okay, Thomas, just to go to you on the question of these oil flows and how that's impacted. I mean, in terms of also inventories. On the product side, the inventories in OECD countries, are not looking too bad. But in terms of supply, how is that impacting how are the fundamentals impacting trading nowadays? Is it purely sort of money market, money funds driven, or are the fundamentals actually going to take an impact? That's the answer to our previous, and that's a different one. A period of sustained high volatility will impact East of Suez markets differently. Agree, disagree. So there we go. We have 65% saying that it will impact the two markets differently.
Maybe back to this question. I think there's a big difference between each of the energy. The oil markets are fairly global. And so the volatility between East and West is not that different. Whereas we found out that the gas market are more regional, so there's a lot of difference between the volatility of gas in the US versus volatility of gas in Europe, and power market is very local. I think what this crisis has highlighted, and especially in Europe, that is you need to invest in logistics to lower the volatility. And one of the reasons why Europe is so vulnerable to gas is because of lack of regas infrastructure, especially in Germany. So we are very dependent on that. If we invest more in logistics, down the road we will lower the volatility of the markets.
Okay.
That's something that is a very strong outcome for me of this crisis, definitely.
Okay, and that infrastructure will take time, obviously, and on the gas side, you mentioned gas, obviously a lot of movement around LNG infrastructure in Europe now, trying to sort of save themselves in that way. Of course, we've seen the gas story this year with the price spikes, which have calmed down a little bit, but how much gas to oil switching do you think we're going to need to see this winter, and how is that going to impact prices?
Well, first, that's the one thing is, you say it's taking time. I think the crisis are such that people do make a lot of very quick decisions, the political decision to install, regas units in Europe, in France, in Germany. Normally it could take years. It took months this time. So when you're in a situation where there's such a huge crisis, suddenly the political decision is there, the economical decision, the driver are there, and the decision are much faster. So again, this is a big plus of this current crisis, is to accelerate the transition to help, solve the market somehow. As far as the gas to oil substitution is concerned, well, if we go back 1 year, I think there was a lot of discussion about it, and some people are talking from 200 a day to 1 million a day. I think at the end, last year is probably between 300 and 400 a day. And now the big question is how much additional gas to oil substitution do you have, meaning that a lot has been done already last year. And so now you still have a range of between 200 to 300 additional this year to 500 to 600 in some of the region. We don't know really, but we are seeing a lot of, investment in Germany in particular, where people are investing in diesel generator to be able to, continue to drive the economy without any gas. So.
Okay, Magid, just maybe you want to comment, but there is a lot of talk now that Europe's actually going to be okay on the gas front for this winter. They've built up their storage, etc. Some people query that. It'll be enough, but they should be okay. And everyone's saying it's next year that Europe's got to worry about. But why? If Thomas is saying that they're getting their act in order quickly, by next winter we'll be all right.
I mean, first, when we talk about, how and when will the switching happen in winter, it's kind of a strange question, because the market prices and the incentives are to switch now, at any point in time. The difference between oil prices and gas and coal and power are so severe that if you have the capability, you'd already be switching. So I think the answer to that question is like, how much more additional capacity could come on that isn't already on? And I think, we've just said here, I think our analysts believe that current switching for this winter should somewhere be in the region of 400 to 500,000 barrels a day, which is, it's only 100,000 barrels a day more than it was last year, because last year we had a situation where Brazil had a hydro problem, and they pulled in another 250,000 barrels of oil demand anyway. And at the same time, we saw the Chinese also switch. So, the net difference is probably 150 to 200,000 barrels a day, which is not that significant in the big picture. In terms of how we're set up for this winter versus next winter, I think Europe has done a very, very good job in stocking. And I think everyone's braced for this winter, so we're not at bad levels at all. And I think, coming into November, we should be close to 100% in terms of storage. And it's price that's fixed that. Government mandates and price. Normally you would expect the winter-summer spread to be reversed, where winter's a premium month. But we've incentivized the market to pull in all the molecules they can, and that's why the summer markets have been very, very expensive. So I think the tools they have is the fact that they've stocked well. I think they're already sort of getting the population ready to tell them that if we do have severe weather, and that's what's going to be the real determinant of whether we're going to be okay or not. It's not the stock levels, it's how severe the winter's going to be. They're already bracing the population to tell them there may be blackouts, so they're telling people to do that. You can see that people are already struggling with their disposable income, so everybody knows that by changing a thermostat by 1 degree, it's going to have an impact. People are buying jumpers, so people are prepared for this winter.
Yeah, and it depends, of course, what governments do and step in to do.
Next winter is the problem, because I don't think, once we've depleted those storage reserves, how do we actually get those storage reserves, filled again? And with the Russian gas was coming for a number of months, and now it can't come. So, can LNG refill next summer for next winter? I think it's going to be the real challenge.
Yeah, if it keeps flowing or not. Okay, let's go to our final survey question for this panel, which is up there on the screen. In June 2022, 7 years after export restrictions from the US were lifted, part of the S&P Global community announced the inclusion of WTI into the suite of assessments in the Brent complex. So what impact will change in the global crude oil product flows have on east of Suez benchmarks? So the flows, and we've mentioned, obviously, we've touched on that this morning. Will these change in product flows and crude oil flows have an impact on benchmarks? Will it have no impact? Should we be looking at adding Russian Urals to those complexes? And the Arabian Gulf may need its own product benchmark as MOPAC may no longer be fit for purpose. So a lot of considerations there, and we'll get our audience to vote on that. Kieran, can I go to you with that in terms of the change of oil flows and whether you think that justifies an impact on benchmarks?
No, I don't. I think, as my colleague Chris spoke about earlier, obviously we need to look at the benchmarks and say, are they currently fit for purpose? It doesn't feel like a market at the moment that needs a host of new benchmarks. Liquidity is poor enough as it is. Ultimately, fundamentals ring through, and the price comes into the front of the market, and the true price comes into the front of the market. We have seen over the last few months Russian barrels coming into this neck of the woods, and those fundamentals play through in the MOPAG quotation. So I feel pretty strongly that it's not a time to start adding new quotations, because ultimately you dilute what's already there, and what's already there is suffering at the moment anyway because of current volatility.
Okay, and if we continue to see these crude flows, the new direction of crude flows, particularly Russian crude going to Asia because it's discounted, it's being taken in by China and India, again, can that impact thinking at all on where Russian Urals could fall into existing benchmarks? Would it warrant considering adding it, considering that it's supplying Asia more than it was?
Well, I guess he's starting to bring in talks of a whole new subject altogether with regards to proposed price caps, etc., like that, and how is Russian Urals going to price over the next even 12 months? Is it effectively going to be based on a different benchmark altogether? Are these going to be effectively G2G deals? So ultimately from 5th, 6th of December onwards, a lot of these barrels aren't going to trade freely in the market anyway, and therefore I think the quotation that's used to sell them is probably the least of anyone's concerns. It's going to be more where they flow to, how they price, and can indeed a price ceiling be introduced effectively for them.
Thank you, Roger. You mentioned price caps, and that's something else I wanted to talk about, but we've run out of time. Thank you very much, gentlemen, for joining us on this trading and volatility panel. Thank you very much. If you'd like to take your seats, please can we have a round of applause for the gentlemen? Thank you.